Okay, so this relates back to both being able to do the math, which was give you some practice doing the math, and to see how, depending upon your industry, what you should expect in terms of a return on assets, and whether the components of that should be coming from asset turnover or from profit margin, what's driving a higher return on assets. We're now going to shift from return on assets to return on common equity, which is just return on assets and you're adding one more item to that, which is your financing leverage. We'll just call it financial leverage right here. So another way to measure profitability is return on common equity, which really says how are we doing in terms of returning value to our shareholders. And that's what it's all about in business at the end of the day. Returning value to your shareholders. So it uses that same net income that we struggled a little bit with. So this net income is the same one we did for return on assets adjusted for financing and taxes. You also subtract out preferred stock dividends, because preferred stock is not viewed in the same category as common stock, and we're looking at return on common stock. So you have to subtract out any dividends that were paid for preferred stock. In order for a company to be successful, you need to have a higher return on common equity than your cost of capital. Otherwise, it could be off on any one period, but over time it has to be greater than your cost of capital, because if it's not, nobody would invest in your company. Why would you invest in a company that's returning lower than the cost of capital? That cost of capital being the rate of return that shareholders should demand for a company of your risk portfolio. As I said, the key component, the additional component of return on capital equity versus return on assets is it brings in this concept called financial leverage. Every company, has its, on one side of the balance sheet is assets, on the other side is your debt plus your shareholder equity. And financial leverage is the amount of debt you're using to finance your assets, essentially. The more debt you use, up until a point, the better the return to your shareholders, because debt is less expensive for you. But there is a point, and we'll talk about that shortly, the tipping point, I'll call it. So financial leverage is a way to get better returns for your shareholders, but financial leverage also increases the risk in your company, and that's the trade-off. And so your cost of capital should go up related to that risk. So, as we said, it's the same, these are the same two things that we had just done for return on assets. And then you multiply that by your leverage, your financial leverage, which is your total assets. And another way of saying total assets is your total liabilities plus your total shareholder equity over your shareholder equity, common shareholder equity. So by definition, this number will be at least 1, right? Because this denominator is also in the numerator, unless you had negative debt. I don't know what that means. So your numerator, by definition, will be a bigger number than your denominator. So you'll be multiplying your return on assets by this leverage factor. And that's what the return on common equity is. Yeah, yes, less preferred dividends, exactly. And in many cases, that's a very small, almost immaterial number. But it'll be in the problem. I mean, if you're given a problem, it'll be in the problem. If it talks about preferred dividends, you shouldn't disregard it. If the problem ignores it, then you can ignore it. And for your companies, to the extent you're doing this for your companies, determine whether it's material or not. I think. So this is another way to look at it. We're not going to get into this in too much detail. Another way to look at your return on assets is your creditors get a return, generally lower than what your shareholders should expect, because your shareholders are taking greater risk, since the creditors get paid before the shareholders get paid. The return to preferred shareholders, which are somewhere between creditors and common shareholders. They're taking on some risk, more risk than the creditors, but less risk than the common shareholders, plus the return to your common shareholders. And the average of that is your return on assets. And that's the return on common equity. Earnings per share. Earnings per share. I both like to talk about this topic and I don't like to talk about this topic. I don't like to talk about this topic because it's not really scientific. But it is probably the most quoted, one of the most quoted numbers you'll see in the marketplace. It's required to be quoted in the marketplace. Earnings per share. Quarterly, every company comes out with their earnings announcement. Leading up to the earnings announcement, stocks react. What's the earning? Analysts are constantly saying we think their earnings are going to be a certain number, and stocks are reacting to that expectation. And as you get closer to the earnings, stocks react to the expectation on the earnings. Then the announcement comes out, and the market has a frenzy. Either it goes up because they've exceeded earnings estimates, or it goes down because they didn't meet estimates. And then usually after that frenzy, it finds its new level, a natural level again. There's actually money to be made right after earnings announcements because the markets are inefficient for a period of time right after earnings announcements. So with that said, it's not as scientific as some of the things we're going to learn here, but it is the most common way to do things. One year, I brought a friend of mine, she's a friend of mine, who's an analyst at Goldman Sachs, and I told her what we teach in class, and I asked her to come in and talk for a half hour, and she did. And she just talked about how all they do is use earnings per share and price earnings ratios and things like that. And I said, oh my God. Because it goes against the better judgment of academia. But it's quick, right? And at the end of the day, speed matters in the markets. And so it's a quick way to get in. They're using the markets because at the end of the day, they want to make money off of the market. If they only use their own, then they're using only part of the information that the market's using. So now we're not going to get too much into the difference between basic and diluted earnings per share. But essentially, basic is just net income minus preferred dividends over the weighted average of the number of common shares outstanding. So the weighted average are the shares at the beginning of the period, shares at the end of the period, on the balance sheet, or given as a note at the minimum. And so that's your earnings per share. The diluted earnings per share, some companies have things like convertible bonds, stock options and warrants that kind of dilute the earnings. So you would add them back in, and then you weight those shares. And so you might see diluted versus basic. Now, I'm going to take us away from this slide for a second. Here's some of the reasons why earnings per share are a little bit crazy. Who's heard of the company Berkshire Hathaway? And who runs that company? Warren Buffett. What do you think their earnings per share is? $4? Other guesses? Class A. Class A. Yeah, no, I'll show. You don't need to look. I'll show it. Any other guess? I got $4. Okay, so here's Berkshire Hathaway. It sells at $171,000 a share. You guys want to chip in, buy a share? Their earnings per share, $9,986. $9,986. That's a bit unusual. So they have a Class B that trades in the normal range, but this is the class that's the true common owners with voting rights and all the rights that come along with being a common owner. They never distribute dividends. They never split their stock. They're looking for a certain class of stock. Their market cap is $280 billion. That's a pretty good number. But how do you compare this to anything, right? Because they've just chosen to have very few shares of stock. So earnings per share is somewhat irrelevant here. Let's take another example. Let's look at Citibank, okay? And we'll look at Citibank compared to Bank of America. So here's Citibank. Trades at about 50. Its total market cap is 160 billion, pretty good number. Their beta, which we'll talk about in a moment, and we'll talk about a lot more next week or 2 weeks from now, is 1.86. The market as a whole has a beta of 1. A beta greater than 1 tells you it's a more risky investment than the market as a whole. Their earnings per share is 2.72. You should be able to read these things, by the way. If not for this class, just for life. And it trades at about $50 a share, $53 a share. Okay? So that is Citibank. And that's Citibank. Their earnings per share, let's remember, is 272. Bank of America, BAC, trades at 14-ish. A similar market cap, about 150 billion. Their earnings per share is 32 cents a share. Their beta is about the same, just showing you that because we'll need to know it later in the semester. So is Citibank a better bank, more profitable than Bank of America? Maybe. Slightly more risky, but you need to be careful. The beta's close. You can say something here? I heard something. The number of shares outstanding matters with earnings per share for sure. Citibank, which I'm a proud owner of their stock. Not really proud, but I am an owner of their stock. I just want to take a look at, well, before I do that, let's look at the chart for Bank of America. It was flying high. Then 2008 hit, right? They were in a lot of trouble, and now it's kind of just hanging out here. Let's go back to Citi. Yeah, I'm going to get there. It was flying high, and it got smashed. It almost went out of business. Both of them needed to get money to stay in business. Oh, certainly J.P. Morgan would be. I mean, we can look at J.P. Morgan in the end. Here's what happened with Citi, because I bought some stock here somewhere. Yeah. I did buy some more down here just to average it out because I said they're not going out of business. But it's going to be a long time before I get that paid back. Citibank was trading at $3 a share. They did a reverse split, a 1 for 10, 10 for 1, whatever. So they reduced their numbers of shares tenfold because they didn't think it was very becoming for a major bank like Citibank to be trading almost like a penny stock. So they went from being a $3 to a $30 without changing anything, just changing the rules. So if they were still a $3 bank right now, what would their earnings per share be? I need to get us there. If they were a $3, they'd be 27 cents a share. They're no better than Bank of America. Other things are equal. So you've got to be very careful when looking at earnings per share. There's a lot more behind it than that.
Do they still have the same CEO?
No, they don't have the same CEO as they had back in 2008. And Bank of America doesn't either. So be careful with earnings per share. Certainly comparing across companies. Did you want to look at Wells Fargo? Let's look at JP Morgan. I think it's a more interesting stock. But we can look at Wells Fargo if you want. JP Morgan with Jamie Dimon at the helm has an earnings per share of 5.6, even with the London whale problem they had. And look, 2008 happened. They weren't happy, but they've held on pretty well. And Wells Fargo might be the same thing. Okay? So that was a little digression for us. So some of the criticisms of earnings per share. It's very difficult to compare across firms. You can do time series comparisons. You know, what was our earnings per share last year, last quarter? That makes more sense. But comparing across firms, there's a lot of variables that are not included. The most important one being, what are the number of shares that are outstanding? But with all that said, it's still one of the main focal points for companies when they're being judged by the markets. When you do time series comparisons, you need to think about that. Things like, are they changing their product mix and their geography mixes? Have they made an acquisition, a divestiture? Have they changed their accounting methods? In this case, a 1 for 10 split or a 10 for 1 split, whatever it might be. Do they have unusual or non-recurring amounts in the earnings per share? And quite often, those are reported as well. You know, one-time earnings or things of that nature. And you all as analysts, your job in this class is going to be to look at stuff like this. And as you forecast forward, understand what's been happening in the past so you have a better estimate of what to expect in the future. Because judging a company's value in the future is based upon understanding what's going to continue to happen going forward. What has been happening and what's going to continue going forward. Okay, so that's the time series. If you do cross-sectional between companies, different industry definitions, you know, even Coke and Pepsi aren't direct competitors. We talked about that on Wednesday. Well, what you ought to do is go backwards and put everything under the new terms. And you know, so you take the older financial statements and do everything under the new terms. In theory, there is no change in the economic value of anything with a split or a reverse split. You know, maybe Berkshire Hathaway, if they were to split, I don't know, 100,000 to 1 or 10,000 to 1, whatever they choose to do, they might change their economic value because they suddenly open up their stock to a whole new class of investor.
So that's like a change in accounting principle.
Yeah. I mean, usually we think of change of accounting principles going from LIFO to FIFO, but that's similar to a change in accounting principles. You do need to be careful about how ratios are computed, particularly beta. There's no one way to compute a beta. I mean, there is a few different models. And so you can compare betas from different websites and they'll be different because they're computed slightly differently. Okay. That's it for profitability analysis. Because we do have a little bit of time here, let's do problem 414 as a team. 414, and only do A, B, D, and E. And this is just more practice with the ratios. 8, I'm sorry? Okay. 414's on 244. A little more practice. I'm going to put this back in here, okay? No problem. Okay, now we'll talk about risk analysis versus profitability analysis. Now there are lots of ratios that we'll talk about. You get to choose which ones are relevant for your company. You don't want to show all the ratios. They kind of tell similar stories. Pretty much, any two numbers in a financial statement could be a ratio, right? So you're looking for those that tell a story that's important about where your company is. We'll talk about ratios related to short-term liquidity, long-term solvency. Then we'll talk about credit risk. This will move away from ratios, and we'll just talk about the components of credit risk. Bankruptcy risk. And there's actually a quantifiable way that's reasonably effective to determine whether a company is at risk of bankruptcy. Looking forward. Market equity risk, which we just mentioned in the last chapter as beta. And we'll talk about it a little bit here, and we'll talk about it a lot later on in the semester. And then you can even quantify the risk that your management team is a management team is manipulating data. And that's something called the Beinisch equation, which we're not going to talk about in class. We are going to talk about this concept in class. We're not going to talk about the formula, the Beinisch formula in class, and I'm not going to put it on the final exam, but you may want to take an analysis related to your companies. Sometimes it comes out interesting. So don't completely ignore it, just know it's not on the exam. Risk. Risk comes from a variety of places, some of it inherent to the business that you're in. Quite often outside of the control of management or the company. If you're an international company, which most companies are, major companies are, exchange rate risk, foreign exchange risk. Host government regulations risk. If you're an oil company in Venezuela, you've been at risk that they may nationalize your holdings. Political unrest, expropriation, which is similar to that. Obviously, there's the risk of recession, inflation, interest rate changes, demographic changes, political changes. These are all risks that are outside of your control. Technology risk. Particularly in today's age, technology can make a company obsolete in no time. Competition, new competitors can come up quickly, regulatory risk, etc. So there are a variety of factors that contribute to risk. Investors need to understand the risk profile of what they're investing in, whether they are shareholder investors or banks or bond holders. Whoever is choosing to put money into a company wants to understand whether that's a good investment or not based upon the risk. Financial risk, related to what we were talking about before, financial leverage. Leverage in general is a technique to multiply gains and loss. We mentioned on Wednesday operating leverage, the idea of replacing variable costs with fixed costs. Have fewer people working and machinery instead of people. If you increase your volumes dramatically, operating leverage should increase your profits dramatically because it's got a lot of fixed costs that'll cover a lot more volume. So you have an opportunity to increase your profitability by replacing variable costs with fixed costs. Comes with a risk. If you don't meet those volume levels and you have these fixed costs that you need to pay for, that's your downside risk. that's operating leverage. We're talking more about financial leverage here, which is the use of debt in addition to shareholder equity. And we disaggregated the ROCE, and we see the financial leverage as one of the three components of ROCE. The higher your leverage, the higher this number, which is going to be greater than 1, the greater risk you have. And there's been lots of analysis on this, and debt is not a bad thing. Debt is a good thing up until something called the tipping point, where your debt level is so high that you run the risk of bankruptcy. And that is the challenge in leverage. Leverage yourself only up to the point where it's valuable and not past that point. And leverage is a huge topic in America, whether it's the leverage that the U.S. government is taking these days or the leverage that any individual company has. And it is an interesting topic.
That's a detriment,
Yeah. It's always the same formula. It's the same thing we did in the last chapter. Just shorten it. Yes, sir. That's the use of leverage. You're individually leveraging your ability to invest. Exactly right. You're borrowing money to invest more. That's leverage. And since we're somewhat amateurs in this world, it's a dangerous leverage because our tipping point can come up on us and we don't know it. Okay, short-term liquidity. So we look at short-term risk, liquidity risk, and long-term risk. So short-term liquidity risk is the ability to generate cash to service your day-to-day needs, your working capital needs. You need to be able to keep your company running day to day. And one of the first rules of life, pay as late as you can, collect as early as you can. And you should do that when you get your bills each month. Pay as late as you can. So that's one way to help manage your liquidity. But there are problems. One, your operating costs might either be greater than or they might precede your revenues. They always precede your revenues, right? You're going to have three things happen before you get paid. Right? You have the costs, you're manufacturing your stuff. Then it sits in inventory for a while. Then you're lucky enough and you sell it. And then you have an account receivable. This is from the period that you started out laying money to when you finally get paid for what you've done. And on the other side, you have the accounts payable. That's when you collect it. It's rare that this is a shorter period of time than this. It's very rare. So naturally, you're going to get paid later than you have to outlay your money. Now, there's sometimes some businesses are such that you get paid in advance. Boeing gets paid as they're producing airplanes and things of that nature. But that's the trade-off. A well-managed company, since they're getting paid more than the cost, they kind of build a little nest egg there so they have cash up front to fuel it themselves. If you have a lot of debt, that's also a reason, because you need to service that debt. You need to pay for that debt. So on top of your operating costs, you also have debt servicing charges of paying off your debt, interest and principal. So a lot of companies have the ability to borrow in the short term through lines of credit. Lines of credit are just relationships with banks where if you need to borrow money, you've pre-planned it, so you don't have to go through a whole process to get the money. There's a certain amount of money that the bank will lend you without question. Or issuing a very short-term commercial paper of some kind. So it's important to do some ratio analyses to understand the liquidity risk of your companies. And there are lots of ratios. Figure out which ones work for you. Probably the most common is the current ratio, which very simply is current assets divided by current liabilities. And you'd like that to be greater than 1. So a lot of these ratios, there is not a target number. But in this case, you want it to be greater than 1. Now remember, current assets are cash, cash equivalents, prepaid liabilities, inventory, marketable securities. So it's not just cash. There are lots of things in this current asset category. What happens if it's too high? You're not giving your shareholders value, right? Why did Apple just pay a huge dividend? It was sitting on cash for a long time because it had its investors believed that they would figure out how to do something valuable with that money better than we could. But at some point, the investor no longer believes that, and so Apple wanted to get rid of that cash, and they did it by paying out a large dividend. They've done it a few times. But you need to be careful interpreting it. Let's say you're a growing company, and you grow your assets and your liabilities equally, and your current ratio is greater than 1 as you would expect. The net effect of that is it's going to decrease your current ratio. Let's say your current assets were $1.2 billion, and your current liabilities were 1. Okay, so your current ratio is 1.2. Let's say you've increased them both by, what's a good number? 0.3, 300 million. So now you'd have 1.5 over 1.2. I don't know what this ratio is, but I know it's less than 1.2. The denominator increased the same, yeah. So if you increase your numerator and the denominator by the same amount, you reduce your current ratio. If you don't do a good analysis on that, you'd say, oh, things are going bad cash-wise or current ratio-wise. But in fact, it's not necessarily bad. And then there's the issue of the fact that inventory is in here, right? That could be managed. Produce a whole lot of inventory even though business isn't good. You're just shifting from cash to inventory. Or have lots of receivables because you're not doing a good job getting paid. So if a good part of your current ratio is tied up in these two items, then the next one will be a quick ratio. Exactly. But current ratio is the ratio you tend to see most often. So the next ratio is the quick ratio, the asset test. Bless you. It's cash plus marketable securities and accounts receivable. Takes inventory out of the equation. And you would interpret it similarly to the current ratio. It doesn't have that hard, fast, has to be greater than 1 kind of attribute, though. Operating cash flows to current liabilities. Cleverly named because it's cash flows from operations divided by current liabilities. Now, you have to use an average on the liabilities because it's a comparison between something that's over a period of time and something from the balance sheet. So you take the beginning and the ending liabilities from the balance sheet. And this is fairly important because cash from operations is what you're really looking for, right? A well-run business should be finding its cash in operations, not from financing, not from investing. A well-run business should be getting their cash from here. So it's a fairly useful ratio. And here's one that shows, again, there's a target you want to be above 40% or 0.4. To see if you're effective. Just because we don't have enough ratios, we'll have revenue to cash ratio. It's the revenues compared to the average cash balance coming from the balance sheet now. Yep, yes. Yeah, exactly. Quarter one, or year one, year two divided by 2. We'll be doing year, in our class, when you're looking at your final project, it'll be years, not quarters. Generally years. Generally, I mean, matters what you're trying to analyze. You know, quarters can have a lot of seasonality in them, and that kind of takes away some of what we're trying to figure out. So, lenders would like a smaller ratio. What does that mean? Lots of cash. So if you're lending money to a company, you want a smaller ratio because you want to know they have lots of cash on hand. The denominator is a big number, and you'll be able to pay them back. But it goes back to the other point. I'll be right there. It goes back to the other point, which is if you have lots of cash, you're not using the money effectively. Lenders are happy, but maybe shareholders are not. Cash is really, whenever we say cash, it's cash equivalents. Things that could very quickly be converted into cash. If you could trade, if it's a commonly traded equity, you can consider that cash, sure. There is risk in the value, and particularly if you have a lot of it, and you can actually change the value by selling. Okay, so that's yes, sir.
Trading securities are different than other types of investment.
Trading securities. So yeah. So we really talk about cash. When we talk about cash, we're talking about cash and cash equivalents. If you could liquidate it right away, then you would include. So yes, you could include trading securities. But again, if it's a security that has a secondary market that in and of itself is a very liquid secondary market, then you can include it as cash for this purpose. Yes. Yeah. Yes. Marketable securities. Okay, we did accounts receivable turnover and inventory turnover and accounts payable. Well, we didn't do accounts payable turnover before, but we know how to calculate the turnovers because we just did it. And a very interesting concept is the days receivables or the days held in inventory, and that is simply taking 365 and dividing it by the turnover ratio. So 365 divided by 10, so receivables takes 36 days for you to get paid your receivables, or I think this is Pepsi. So it takes 36 days for Pepsi to get paid their receivables. They're holding their inventory for 40 days. Now, the good news is they're paying in 45 days. So that's good compared to receivables. I mean, that's a pretty good comparison, right there. It's because they're Pepsi and they can. And similar to what we had said there, your days accounts receivable outstanding, 36, plus your days of inventory of 40, minus your accounts payable of 45, tells you the number of days you need to finance in some way. And you can either finance it internally through cash you have on hand, or you have to find another source of financing from the external markets.
For the days receivable outstanding, what would you consider a good number? Is it all depending on the company?
It's really depending upon the company. What would you consider a good number if somebody owes you money?
Well, as long as the payables are longer than receivables, then I guess that would be good.
Right. And you oftentimes you'll have terms on these receivables, so you'll try to force them to pay early by having a discount based on early payment. The problem with receivables is as they extend, it's not only that you're not getting the money fast enough, but the probability of getting the money decreases the longer the receivable goes. So it's the combination of the two that keeps you wanting to keep your days receivable shorter. So how many days does Pepsi need to finance here? No calculators. 31. Okay. I don't know who said it, but it's correct. It's 36 plus 40 minus 45. 31. Okay, let's switch over to long-term solvency. And this is your ability to satisfy your long-term debt. Long-term debt's usually purchased so that you can invest in long-term assets. That's the purpose of long-term debt. And you use your financial leverage because you, rather than putting more shares out in the market and having to pay off more shareholders and therefore diluting their ability to get a return, you look for creditors who accept a lower rate of return for lower risk. Their risk is lower because should something happen to the company, they get paid first. So since debt provides leverage, it's not necessarily bad up until a tipping point. That tipping point is the point where your bankruptcy risk becomes a real threat. And what you're really looking to do is generate cash from operations to pay for your financing. It's not acceptable to pay for your financing through new financing on an ongoing basis. Eventually, that doesn't play. We'll look at debt ratios, interest coverage ratios, and operating cash flow to total liability ratios. Again, you could choose which of these work best for you. We have 4 different debt ratios for you to take a look at. And they all say the same thing. It measures the amount of liability that you have. It really measures your leverage. The higher your debt ratio, the more risk of insolvency. And there is no magic number where you hit a certain number and therefore your risk of insolvency is beyond the ability to recover from. As you would expect, there is no magic number. So the first one is long-term debt to long-term capital. It is exactly what you think it is. It's the long-term debt over long-term debt plus shareholders' equity, so this is your long-term capital. it takes out of the equation short-term debt from both sides, the numerator and the denominator. So it's really what's your long-term, your ability long-term to leverage. Long-term debt to equity ratio is just long-term debt over equity. It's not much, it's just different numbers. Doesn't tell you anything different. Your total liabilities to shareholder equity differs because it includes short-term debt. And total liabilities to assets, because total liabilities, assets are total debt plus equity. So this is your percentage of debt. This is what we use for our financial leverage. Okay, so again, these are 4 different ratios. There's no magic number. I would suggest choosing one of them. They don't tell you very different things. So Pepsi's liability, total liability of shareholder equity is 107%. What does that tell us? More debt than equity. Just a little bit more, but more debt than equity. This is the one ratio where being over 100% is normal. If you look at the others, taking out of the equation short-term debt, you'd expect it to be less than.
It's all a balance of which one is cheaper. Do you want to give equity and give dividends, or you want to?
Right. The best companies have debt. Everyone has debt. Right? Because you want to leverage your ability to bring shareholder value. Now, if you're a company in decline, you should be paying off your debt so that your shareholders are not saddled with a bankruptcy at the end. So if you've gone through your life cycle and you're in decline and you can't see a way out, you should be paying off your debt and get your debt close to zero at that point. Right. Okay, interest coverage ratio, a new ratio. So you have to pay off your interest, your long-term debt. So interest coverage says how well is operations paying your interest? And you'd expect it to be some kind of a multiple. This should be greater than 1 for sure. So you take your net income, you add back your interest expense and your income taxes just like we did before. And now you add back one other item, minority interest and earnings. It's a different word interest than this word interest. This is if you're a minority shareholder like Pepsi is of their bottlers. That's considered net income for this purpose. So you add that into the equation as well. So you look at your ability to earn money through operations compared to your requirement to pay off your debt coverage. The fixed charges coverage ratio includes things like pensions and lease payments as well. So it's very similar. Operating cash flow to total liabilities. Cash flows over your average total liabilities. Remember, liabilities is balance sheet. Cash flows are coming from the statements of cash flow. And this is telling you whether or not you're able to generate cash flow to cover your debt.